Right now, 20% of the world's oil supply is blocked. Not slowed, not disrupted. Blocked. The Strait of Hormuz, that narrow corridor of water between Iran and Oman, that every oil tanker, every LNG shipment, every barrel bound for Europe and Asia has to pass through, is closed. And this morning, silver opened at $77.05 an ounce, up 1.8% overnight. Because the peace talks that were supposed to fix this, they collapsed in Pakistan last night. No deal, no framework, no ceasefire. Just failure. And right now, as you're watching this, Emmanuel Macron is sitting in a room in Paris with representatives from up to 40 nations, trying to hold together an emergency coalition to reopen that strait before this turns into something far more dangerous. This is Recession Warnings, and today, April 14th, 2026, is not a normal day for silver. I want to start with the number that most people are going to miss because they're focused on the price and not the mechanism. 20%. 1 in 5 barrels of oil that moves anywhere in the world passes through the Strait of Hormuz. That includes the liquefied natural gas that powers factories across Asia. That includes the crude that European refineries depend on to function. That includes the energy inputs that make everything from solar panels to semiconductors possible. When that corridor closes, and right now it is closed, the inflation math for every single energy-dependent product on Earth changes overnight. And silver sits directly at the center of that math. Here's why. Silver isn't just a safe haven metal, it's an industrial input. It goes into solar panels. It goes into electronics. It goes into the manufacturing supply chains that run on the same energy that's currently being choked off at Hormuz. So when energy prices spike, you get two forces hitting silver simultaneously. Production costs go up because it costs more to mine and refine. And at the exact same time, investors who are watching inflation accelerate start moving into hard assets. Physical silver, allocated accounts, silver ETFs, demand surge, supply squeeze. At the same time, that's what we're watching right now. And the Paris summit is sitting right at the center of it. Let me tell you exactly what Macron is trying to do today, because this is where the geopolitics and the silver chart connect directly. France and the United Kingdom, President Macron and UK Prime Minister Keir Starmer, are co-hosting what they're calling a strictly defensive multinational naval mission. The goal is to establish a protected shipping corridor through the Strait of Hormuz that gives international vessels a way through without triggering a direct military confrontation between the United States and Iran. Think about what that requires for a second. The US already has naval assets active in the region. The Americans launched their own operation. Real ships, real presence, real capability. Macron is essentially trying to build a parallel diplomatic track that gives the international community an off-ramp that doesn't depend entirely on Washington. It's ambitious. It's complicated. And it's happening right now. The number to watch is the coalition size. Reports indicate between 15 and 40 nations are involved in today's talks. That's an enormous range and that range tells you something important. There is genuine uncertainty about how many countries will make real commitments versus showing up for the photo opportunity and quietly backing out when it costs them something politically. If you see more than 20 nations commit to active participation, ships, personnel, political capital, that's a credible operation. If the number stalls at 12 or 15, with most nations offering only passive support, then what Macron has built is a symbolic gesture, not a functional solution. And the silver market will price that distinction in real time. Now, I want to stop for a second because there's something important to address here. The failed Pakistan talks. I mentioned them at the top, and I want to give them the weight they deserve. These weren't minor preliminary discussions. The negotiations being hosted in Pakistan were being widely pointed to as the most viable diplomatic off-ramp for this crisis. Analysts were watching them. Markets were watching them. The back channel was active, and then it wasn't. The talks collapsed with no deal, no partial agreement, no framework to build on, just failure. And the market responded immediately. Silver climbed 1.8% in overnight trading. That move is not just momentum. That move is the market saying, the easy path to resolution just closed. And we're now pricing in a world where the blockade holds longer than anyone was hoping. Think about where we started. 18 months ago, silver was trading below $35 an ounce. In late 2025, it crossed $60. Earlier this year, it touched $100, and this morning it opened at $77.05. Now, I know what some of you are thinking. If it already hit $100, why are we at $77? That's a fair question, and the answer matters. The $100 touch was a moment of peak uncertainty. The market ran hard, got there, and then pulled back, as some traders took profits and others waited to see if diplomatic channels would come through. The pullback to the low 70s wasn't a repudiation of the silver thesis. It was a consolidation while the market waited for confirmation that the risk environment was going to persist. Now, look at today. Pakistan talks gone. Hormuz still blocked. Macron in Paris scrambling to hold together 40 nations. The confirmation the market was waiting for is arriving, and it's not reassuring. This is why $77 this morning is not the same as $77 6 months ago. The floor has shifted. The structural case for silver is not weakening. It's being reinforced in real time by events that nobody can spin as temporary. Drop a comment right now. Where are you watching this from? I want to know what this energy situation looks like from your corner of the world. Because the Hormuz blockade doesn't just affect traders and investors, it affects everyone who heats their home, fills their tank, or buys anything that had to be manufactured or shipped. Let me walk you through the two scenarios that are going to determine what happens to silver over the next 2 to 3 weeks. Scenario 1. Macron succeeds. The Paris summit produces a credible agreement. More than 20 nations sign on with concrete commitments. A multinational defensive corridor gets established in the Strait. And over the next 2 to 3 weeks, oil tankers start moving again. In that scenario, you'd likely see a short-term pullback in silver as some of the geopolitical risk premium comes out of the trade. $75, maybe $73. But here's what most commentators will get wrong if that happens. They'll call it a reversal. It's not. The structural drivers that have been pushing silver since 2024 don't disappear because one shipping lane reopens. Solar expansion is still accelerating. Industrial demand is still growing. Currency concerns haven't gone anywhere. A pullback in that scenario is a breather, not a breakdown. Scenario 2, Macron fails. The coalition fractures. Key nations offer only symbolic support. Iran refuses to recognize the legitimacy of a multinational defensive mission. The U.S. operation and the Paris framework end up working at cross purposes. The Hormuz blockade holds. In that scenario, the energy premium stays locked into the market. Inflation expectations that were already elevated get a new catalyst. And silver, which has already demonstrated it can handle enormous institutional buying pressure, has no reason to pull back and every reason to continue climbing. Both outcomes are constructive for silver's medium-term trajectory. That's what makes today's summit a genuine inflection point rather than just political theater. It's a binary event with asymmetric implications, and both sides of the binary keep silver in a bullish structure. The question I keep coming back to, and I think it's the one you should be sitting with right now, is this: what does the market actually know that we don't? Because silver at $77 isn't an accident. Silver at $77 after a 1.8% overnight move following the collapse of peace talks isn't a coincidence. The institutions, the central banks, the informed buyers who move real volume in this market, they're watching the same summit in Paris that you're watching. They're reading the same reports out of Pakistan. And the number they're pricing in right now tells you something very specific. They don't believe this gets resolved cleanly, and they don't believe it gets resolved quickly. That's what $77 is saying. It's not panic pricing. It's not euphoric momentum. It's the price of informed uncertainty. The market believes there's still a chance diplomacy works. That's why we're not at $90. But the market also knows the worst case path is more credible today than it was 72 hours ago. That's why we're not at $70. The floor has risen. And the ceiling is actively being debated in trading rooms right now. Right, let me give you the inflation framework that connects all of this, because I think it's the piece that most silver commentary glosses over in favor of pure chart analysis. When an energy choke point like Hormuz gets disrupted for an extended period, and we may already be past the 60-day threshold depending on which estimates you're using, something structural happens in global manufacturing. Companies don't just absorb higher energy costs in the short term. At some point, they reprice their entire cost structure. Shipping rates go up, chemical inputs go up, agricultural production, which runs on diesel and natural gas-derived fertilizers, goes up. And when that repricing happens across enough sectors simultaneously, inflation stops being transitory and starts being entrenched. That's when central banks face the decision that silver investors care most about. Do you raise interest rates hard enough to kill the inflation, knowing that doing so will likely trigger a recession? Or do you tolerate elevated inflation, let the economy run hot, and accept that hard assets are going to absorb the excess? History gives us a very clear answer on which path central banks have tended to choose when the inflation is being driven by real-world supply disruption rather than monetary excess. They have repeatedly chosen to tolerate it, and every time they've made that choice, silver has been one of the primary beneficiaries. That's the macro backdrop that Macron is walking into today. He's not just trying to reopen a shipping lane. He is, functionally, trying to prevent the conditions that would force that central bank dilemma. If he succeeds, the global economy gets a reprieve. If he fails, the silver market may be the cleanest place to watch the consequences in real time. I want to talk specifically about who Keir Starmer's presence at this summit signals, because I think it's being underplayed in most of the coverage. The UK, post-Brexit, has been navigating a complicated position, trying to maintain its transatlantic relationship with Washington, while also re-engaging with European partners it officially separated from. The fact that Starmer flew to Paris to stand next to Macron on a mission that is explicitly framed as an alternative to the American approach, not hostile to it, but parallel to it, is a significant diplomatic signal. It means London has decided that this crisis is serious enough to risk the optics of appearing to operate independently of Washington. That doesn't happen by accident. That happens when the threat assessment in Whitehall is telling decision makers that the Hormuz situation has moved from manageable disruption to genuine systemic risk. Silver understood that before the press conference did. Now let's talk about the physical market, because the price action in the futures market is only part of the story. What's happening in physical silver right now tells a different story than the spot chart. Premiums on physical silver coins and bars have been elevated for weeks. Delivery times from major dealers have stretched out. The disconnect between paper silver and physical silver that the recession warnings community has been tracking for months has not resolved. If anything, it's widened. When you have a futures price that's moving up while physical premiums are also rising, that's not a market that's overcrowded on one side of the trade. That's a market where demand is genuine and broad-based. Retail buyers are stacking, institutions are allocating, and central banks, particularly in Asia and the Middle East, have been adding to their precious metals reserves in a pattern that started well before the Hormuz crisis and has only accelerated since. The physical market is not blinking. And when the physical market and the paper market are both moving in the same direction, the trend has considerably more structural support than when it's just momentum traders chasing a chart. For those of you holding physical silver right now, coins, bars, allocated accounts, today is a day to pay attention without panicking in either direction. If you've been waiting for confirmation that the thesis was correct, here is your confirmation. The global disruption that makes silver both a safe haven and an industrial necessity is not theoretical anymore. It's live. It's in Paris. It's in the wreckage of the Pakistan talks. And it's sitting at $77 an ounce on your screen right now. For those of you who have been watching from the sidelines, waiting for a pullback, waiting for clarity, waiting for confirmation, I want to ask you a direct question. What does clarity look like to you? Because if a blocked strait, failed peace talks, and an emergency summit of 40 nations isn't clarity, I'm not sure what you're waiting for. That's not me telling you to make a financial decision. That's me asking you to be honest with yourself about what your actual criteria are. The pullback may come. It probably will come at some point. Every asset consolidates. But the medium-term structural case for silver, the industrial demand, the solar expansion, the currency diversification happening across the global south, the inflation hedge function that's being reactivated right now by real-world events, none of that resolves on a timeline that makes sitting in cash feel safe for years on end. The Paris mission is not the end of this story. It is one chapter in a much longer narrative about what happens when the architecture of global trade, built on cheap energy, stable supply chains, and unchallenged dollar dominance, starts cracking under the weight of real-world events that were entirely predictable and almost entirely ignored until they weren't. Silver is one of the few assets that sits at the intersection of every single one of those cracks at once. Industrial necessity, inflation hedge, alternative store of value. And today, with Macron in that room in Paris, with the Hormuz blockade holding, with Pakistan in the rearview mirror, and with $77.05 on the screen, all three of those stories are live simultaneously. So here's what I want from you in the comments right now. Two things. First, your price prediction for silver's close tonight. Are we closing above $77.50? Does the summit produce enough optimism to pull us back toward $75? Or are we building towards something bigger by end of week? Give me your number and your reasoning. This community has called silver moves before the mainstream caught up, and today is exactly the kind of inflection point where your analysis matters. Second, where are you watching from? This channel reaches people who understand that what happens in the Strait of Hormuz affects the price of everything, everywhere. And I want to know which corner of that world you're watching from. I read every comment, everyone. The Paris mission is live, silver is moving. And the question the market is asking right now, the one that $77 is the current answer to, is simply this. Do you trust diplomacy? Stay sharp. Stay informed. This is Recession Warnings, and we'll see you in the next one.